What's going on, guys? Welcome back to the channel. My name is Mark and this is 360 Finance. In today's video, we're going to be discussing if debt even matters anymore, as the COVID-19 health pandemic has forced central banks to lower interest rates to basically zero, provide these trillion-dollar stimulus packages to unemployed Americans. National debt has risen as high as it's ever been, okay? And in today's video, I want to go a little bit through why that's happening. I want to talk a little bit about the S&P 500 Q2 earnings results and what this means for the stock market. I'm going to talk a little bit about the future of the US dollar and why I think it's going to be devaluing in the near future. And then we're going to talk a little bit about cryptocurrency and how you should be strategizing your investments, okay? So I'm sure a lot of you guys are wondering, how does this debt even affect me? We're going to be talking about that, and yeah, so let's go ahead and get into it. So the first thing I'm showing you guys here is the debt clock, and as you can see, it is accelerating at over hundreds of thousands of dollars per minute. That's crazy, and that's really exponential growth, and US national debt is as high as it's ever been. On this website, they break it down between two things. Or two categories: debt held by the public as well as intergovernmental holdings. So the first graph I'm showing you guys here is that breakdown, and you can see basically since 2008 the debt held by the public has grown at a much faster pace than intergovernmental holdings. And you can see even in the past year there's been another huge uptick in that. Okay, so that's a little bit alarming for me just off the bat here. Okay, so public debt is basically business loans. We're talking about mortgages that everybody pays into, and then the intergovernmental debt here is basically, you know, pension payouts or pension obligations, Medicare trusts, as well as trust funds. You can see that that growth has been a little bit more steady in relation to the growth by the public debt. The second graph here I'm going to show you guys is debt as a percentage of GDP, and as you can see here, it's as high as it's ever been since the 70s, basically, all the way up at 80% of GDP. There was a tweet that I saw. I'll try and find it for the sake of this video. It was basically showing that debt as a percentage of GDP is as high as it's ever been since World War II. Obviously, we're in a much different environment now than we were during World War II. Okay, World War II, we were in a world war. People were deploying across seas, and more of the industrial companies were thriving from that. Not that war is a good thing, but what we're going to see thrive in this environment is more so the healthcare companies, the tech companies, as we've already seen. The pandemic is obviously much different than a world war. What has allowed this debt to balloon to incredible amounts is, in my opinion, the interest rate. Okay, so you can see here, this is the effective federal funds rate going back all the way to the 50s. And I don't think we'll ever see interest rates as high as 20% as they were in the early 80s there. That's absolutely insane. But the fact that the federal funds rate is, you know, lower than 25 basis points kind of allows for more people to take on more debt, okay? So what I mean by that is, if you're offered 5% on a mortgage, you're going to be paying X amount of interest over time, and you can only afford a certain amount of principal based on that 5% interest rate and the life of your mortgage. If you are offered a 2% interest rate, the principal that you can afford is going to be much greater because you don't have to pay as much interest over time on the loan. So I think the fact that the federal funds rate is so low has allowed for debt to balloon. All this has pointed or has allowed for the NASDAQ to have a historic run-up in price. As you can see here, it's as high as it's ever been. And for any of you who don't know, the NASDAQ is comprised mainly of tech companies. I forget the actual percentage of tech companies within the index. I'll try and find a graphic just to put up on the screen here. But you can see that they've never been valued this high ever. And let's tie that in a little bit to the S&P 500 price versus their earnings estimates. And you can see here that these are two data points which are pretty much correlated. If you see earnings estimates go up, you're likely going to see an increase in the S&P 500 price. And the S&P 500, again, an index that has the 500 highest valued companies in the US. What we're seeing here in 2020 is a huge divergence pattern. As earnings estimates are going down, you've seen the stock market shoot up back again to historic prices. So they're going in opposite directions, but they are a correlated data set, or they're correlated data points. So what I believe we'll see here is a little bit of a reversion to the mean, and the price of that stock, or the price of that index, sorry, is going to be coming down in the near term until we see a massive increase in earnings estimates, which we are currently not seeing. Speaking of earnings estimates, let's talk about companies that actually gave guidance. So 32 companies in the S&P 500 actually didn't give guidance. So if you actually break that down by sector, the companies not reporting guidance the most right now are industrials and consumer staples, whereas healthcare in technology are providing their guidance more often than not. So I think that's pretty straightforward. That's obvious. These stocks that are per se stay-at-home friendly stocks are doing extremely well in these turbulent times because they've been able to adapt accordingly. A lot of the companies in energy, a lot of the companies in consumer staples, they kind of have to rely on that demand to get them through these tough times, which they're not currently seeing. Okay, so again, looking at the sector breakdown in terms of which companies actually hit their guidance versus companies that didn't, you can see the top three here that missed were consumer discretionary, telecommunications, and energy. Although energy, there was a chunk of companies that were in line with their earnings. So maybe I'll just talk about consumer discretionary a bit here. I think the retail apocalypse is alive and a real thing in today's world. You're seeing all these brick and mortar stores shut down because they have no demand. People aren't going out to malls. People aren't buying things. They're just buying things online. And if you don't have an online presence, that's a big problem for you. These companies are shutting down because they can't pay their rent. So Q2 earnings growth, you can see some of the sectors here being hit extremely hard. I did see a tweet in regards to this fact set, Q2 earnings growth being as bad as it was all the way back to 2008, Q3 or Q2 or Q4 in 2008, which was the financial crisis. In this situation, the stock market's at all-time highs and it's not tanking or crashing because we're getting these massive stimulus packages to kind of prop up the market. So a little bit of a bubble potentially. If you look at the 10-year forward PE average versus the 5-year and the 10-year historicals, you can see that's also at all-time highs and way above the 5-year and the 10-year average. And you can see here there's a massive uptick, obviously, in 2020. Again, a little bit scary. You do see more gradual growth in these type of things, and whenever you see a huge uptick, I think you can always kind of expect a reversion to the mean, which would mean a lower stock market in the near term here. So basically, what does this all mean? I know I just gave you a lot of information on Q2, but as debt continues to accumulate, I think we might see a little bit of a devaluation of the US currency. So I live in Canada, so I'm going to compare it to the Canadian loonie. Currently, it takes you 75 cents to buy 1 Canadian dollar, about a 25% premium there to buy the US dollar if you're Canadian. But where I want to tie that in is into the M2 money supply. And you can see the gray patches here on this graph are all the times that the US went into recession. Again, a gradual increase, and we're seeing a massive uptick in 2020, which is definitely an outlier in compared to previous recessions. A little bit scary in my opinion. Fiat currency compared to cryptocurrency. Fiat currency, there's no limit to the supply basically. If something like this happens again next year, something happens again like this in 10 years, central banks can simply print money and give that to people who are unemployed. So the difference between that and cryptocurrency is there's typically a finite amount of cryptocurrencies, okay? So we have an inelastic supply with potentially growing demand in the future. So what I'm showing you guys here is just an economics 101 graph diagram of inelastic supply. Let's just say, for instance, there's 15 people who want to buy Bitcoin, okay? And there's only X amount of Bitcoin to be mined ever. And I forget the graph, how much there is, but I'll put up a graphic of how much there's expected to be by the time all the Bitcoin is mined. Okay, so we know that there's that many Bitcoin. If 15 people want to buy it, it's 30 bucks, and let's say one extra person wants to buy it at a higher price, then it's 40 bucks basically, right? So the higher the demand, the more that this asset will go up. That's definitely the bull case for Bitcoin, okay? So I'm going to talk a little bit about the bear case now. and some leaked slides from Goldman Sachs where they give their reasons as to why you shouldn't invest in Bitcoin, and they don't believe it's a suitable investment for their clients. So the first one is that they do not generate cash flow like bonds, okay, or they don't pay a dividend yield either. If you're making money with cryptocurrencies, it's simply based on the fact that it's coming from capital appreciation and there's no form of income in this asset. They do not generate any earnings through exposure to the global economic growth. That just means that they're not a company. It's simply an asset, simply a store of value. It does not provide consistent diversification benefits given their unstable correlations. So again, when we're talking about correlations, some sectors tend to have positive or negative correlations with other asset classes. What they're saying here is that Bitcoin basically doesn't have correlations to any asset class. It's just its own thing. So you don't have diversification benefits from owning some. And do not dampen volatility given historical volatility. So all they're trying to say here is that when the market goes down 20%, Bitcoin's going to go down 40%, and vice versa if the stock market goes up. And it does not show evidence of hedging against inflation. So that they believe that a security whose appreciation is primarily dependent on whether someone else is willing to pay a higher price for it is not a suitable investment for their clients. They also believe that while hedge funds may find trading cryptocurrencies appealing, because of their high volatility, that allure does not constitute a viable investment rationale. So I would say my personal opinion with cryptocurrencies is that I lean a little bit more towards the bear side. I agree that investing in something that you're expecting to make money on only because someone else will buy it at a higher price is probably not a suitable investment. It's a high-risk investment, and it's just not something that would be suitable for my own personal portfolio. Obviously, you can do what you want with your own personal portfolio. I am simply providing the information here. So I'm going to give you guys some investment strategies as well as some personal development strategies that you can facilitate with your own portfolio or life and why you should be doing them during these extraordinary times. So the first one's pretty simple. Obviously, diversify currencies and diversify industries. If you're Canadian, all your money is in US stocks, maybe you want to start looking at buying some Canadian stocks, or maybe you want to just diversify to the Canadian dollar instead of the US dollar instead, and just to hedge yourself against the downside risk there. Industries, obviously you always want to diversify industries, if you have all your money in tech, yes, there was a historic run up in tech in the past couple months, but maybe you want to take some of that money out of tech and put it in a different industry just to protect yourself against the downside risk, as well as just get exposure to different types of businesses. The second one is to buy companies that you're willing to hold for at least 1 to 3 years. Avoid, day trading, basically, is what I'm trying to say here. In the past, people might have advised more along the lines of only buy companies that you're willing to hold for 5 to 10 years, and that's definitely some more consistent or some more traditional Warren Buffett type of advice. I think given the amount that fundamentals have not mattered at all in 2020, you might want to learn a little bit more about behavioral investing and maybe shorten the time frame or time period that you're willing to earn a stock so that you can capitalize on capital appreciation quickly. Third one is to buy real estate to hedge against inflation. Obviously, you're trying to avoid bad debt. Obviously, you want to build assets instead of liabilities. Purchasing a home, starting to invest into real estate is a natural hedge against inflation, and it's a great way to start building an asset class. Maybe try house hacking or adding people or adding roommates to your house so that you can essentially live at your house for free while also paying down your mortgage. Real estate, I think, is a very key industry, and I think it's something that everybody should do. Everybody should own a home at one point in time in their life. Fourth piece of advice is to invest in yourself. This is self-explanatory, but obviously you're going to be getting good jobs through highly skilled, highly specialized skills. And as millions and millions of people are actually losing their jobs right now, the best thing that you can do is actually secure your income. If you're in your early 20s or your mid 20s like me, chances are that your investment income is not as much as your earned income at this point in your life. So the best thing you can do is invest in yourself. And you can do that through various methods, reading books, going through online courses, watching YouTube videos like you are right now, and learning new things day in and day out, and making sure that you have knowledge that makes you valuable in today's society. And then the last piece of advice is just to build your social relationships. Your net worth is your network. A famous quote that I like there. So Just make sure you're constantly building your circle, meeting new people, testing your boundaries, and taking risk as needed and when it's appropriate. Okay, so that's all I have for you guys today. I hope you guys enjoyed the video. If you did, please don't forget to smash the like button. Share the video with a friend if you learned something. And yeah, I'm glad you guys, or hope you guys enjoyed the content, okay? I'll see you guys in the next video. Peace out.
Young age, learn how to get paid. Big stage, long way from session A. Big wave, he gon' have to get saved.